Okay, class, let's turn to the agency problem. Of course, if you're a partnership or sole proprietorship, you will face no conflict because you're managing your business and you're the owner. In large corporations, the owners of the companies are the investors, and they become owners by, as we've talked about in past slides, purchasing the stocks of the company. We also have a chapter on stocks, so we'll deal with stocks later on. The agency problem is that managers are not shareholders, and they may be looking out for their best interests, such as job security. The agency problem comes down as you have two different sets of individuals, and I should say individuals, and they have their own agenda. What they need to do is align it with the shareholders here, because the most important thing is to increase the value of the company. Now, financial managers here, or managers in general, may be looking, like I said, for job security. They may be picking short-term solutions instead of looking at the long-term solution. They could be decreasing dividends, not paying dividends, reducing the stock value of the stock, which is all types of things that a stockholder would not want to see. But anyway, do managers maximize shareholders' wealth or the manager's wealth? Okay, now there's stakeholders here. I want to talk about this. We talk about the stockholder, but there's a lot of people that are stakeholders in a corporation. Those would be like a couple examples would be suppliers and the government. Now you might say, well, the government. Well, why would the government be concerned about a company? Because the company there pays taxes. So at all different levels, federal, state, and local, could be receiving a share of taxes based on the profits from the corporation. So they would also want to see the business grow, because then their taxes or revenues coming in from taxes would increase. And here is another slide on agency problem. Basically, I discussed a lot of this in the last slide here. Agency problem here, like I said, managers are agents for the stockholders and are tempted to act in their own interest rather than maximize value. They may take extra perks. They may fly in Learjets, spend money on parties, things like that, which is going to take away from the profit for the company. Of course, the agency cost is the value lost from the agency problem, or from the costs of migrating agency problems here. So what needs to be done is need to line up the concerns of stockholders along with the concerns of the management. And here's a figure in the book here, basically giving you a visual of ownership versus management. Of course, stock prices versus returns. Stockholders would want stock prices to go up, and returns, if there is a dividend paid, to also go up. Now, manager would also want the stock price to go up also, because if stock prices go down, you could have a hostile takeover. And a lot of compensation here for managers are based on stocks, options, things like that. They're given a low salary along with performance, things like I said, stock options. And if stock prices go up, then they're going to earn more money during that year. Okay, dilution of ownership here. We're going to get into this in further chapters here. We need money for a new project, and there's three basic ways you can use retained earnings and pour the money back into the corporation and not pay a dividend or pay little dividends. You could take out debt, or you could, with this particular dilution of ownership, issue more stock, which could dilute the ownership value for a investor. Now, dividend policy, are they paying dividends? Are they increasing? Are they staying the same? A lot of stockholders, especially my age here, I'm looking for companies that pay dividends to help with my return. Of course, there's the financing decisions, which we sort of talked about when we talked about dilution of ownership. Of course, there's the manager versus stockholders, which we already talked about. You even have differences between top managers and lower level managers, and stockholders versus banks and lenders. So equity versus this would be your debt side. They all have their concerns. Okay, hopefully with the agency problem, the corporation has corporate governance. That means laws, regulations, institutions, and corporate practices that protect shareholders and other investors. Other investors is, not just the stockholders. If I own a bond, then I expect interest, and when the bond expires, the principal back. Okay, let's talk about some elements of good corporate governance. Of course, the legal requirements. Good governance require that the stock and the managers are going to obey laws, regulations, and hopefully there are law regulations that protect investors from self-dealing CEOs. And financial managers and managers in general, including the CEO, has a fiduciary duty to stockholders. That is, that they are required to act fairly and responsibly in the stockholders' interests. So hopefully they're not doing an Enron where they're telling everyone to, keep hold of their stock, do not sell it, but on the backside they're selling their stock so they don't lose money on the stocks going down with the Enron case. And there's a whole bunch of examples when we talk about not obeying the laws or having good corporate governance. Of course, investors would want to have a strong board of directors. The board of directors appoints top managers, including the CEO and CFO, and they must, of course, approve most of the most important financial decisions for the companies. For the company, of course, turning to takeovers there. If the stock price does go down, then there's a good chance that the company might be bought or have a hostile takeover, which most likely means that if a company is taken over by another one, that the top management, they're going to have to find a new job, and that could also have a bad impact on stockholders with their stock prices going down and with no dividends. Of course, with all investors, they want to be able to get the information that's needed, like balance sheet, income statement, cash flow, 10K. In fact, your project is using the information from the company to make a decision if you're going to purchase the stock. So investors need this information. Bankers and lenders need this information to loan money to the company. Okay, future coming attractions for this textbook. We're going to turn here how to calculate the value of a stream, future cash flow. We're talking about time value of money. You're going to learn more than that. You're going to learn the basics of time value of money. If you take MBA 505, then you're going to receive more details on the time value of money. Of course, you want to be able to measure risk. Hopefully, in other courses, and a little bit in this course, we're going to talk about not only how you measure risk, but how you protect yourself from risk. Where does financing come from? We touched on it a little bit in this particular chapter. Sure, firms' financially decisions add up to sensible, as a whole here. And let's see here, last one. What about some of the other responsibilities of financial managers that we mentioned earlier? So we're going to, like I said, this chapter here was more of an introduction to finance, and we'll get into more of the nuts and bolts in the future chapters. That's it for this chapter.